Good morning, good afternoon, and good evening, everyone. Welcome to today's webinar by DataPlatformGeeks. My name is Rohit, and I will be your host for today's webinar. And our today's session is on applying forensic accounting techniques using SQL and R by our speaker, Kevin Feasel, who's an MVP from USA. Kevin had already delivered a data science webinar for us on 4th April. And our today's moderator will be Satya Ramesh. eDominus Systems, a lot of you already know about eDominus Systems and its popular brands. We have the SQLMaestros, where we offer a lot of training under masterclasses, where we recently concluded masterclasses, which I will talk about a little later. We have the learning kits, the video courses, the hands-on labs. We have the Peopleware India, where we offer a lot of corporate training. And of course, our popular ERP product, Expand SM ERP. Satya will be putting down all the links for you to use. And then we have DataPlatformGeeks, of which you all are part of. It is Asia's one of the largest data analytics community. And under DataPlatformGeeks, we have our annual summit, that is Data Platform Summit. We have launched DPS 2019 this year. It will happen in the month of August. And as you can see on your screen, that is the theme and logo for DPS 2019, Empowering Data and AI Transformation. It will be a 3-day conference and 3 days of pre-cons this time. This is the first time we are doing 3 days of pre-cons. There will be around 18 pre-cons and 16 of them are already announced, and it will happen at Radisson Blu, Bangalore. This is a picture from the last year's summit, DPS 2018. You can see more than 1,000 people on your screen participating from 300 plus companies and from 16 plus countries. On the stage at the back, you can see Rohan Kumar, who is the corporate vice president. He had flight down to give a keynote with his Redmond team. As I mentioned, DPS 2019 will be 3 days of conference on August 22nd, 23rd, and 24th, and 3 days of pre-con training on August 19th, 20th, and 21st. We will have 7 technology tracks, and more than 100 sessions will be delivered at the conference. And we will have, of course, 50 plus speakers, globally renowned speakers flying down from more than 16 countries. Yes, the world's best will teach here, starting from Microsoft Redmond speakers to MVPs, MCMs, RDs, and whatnot. And then one of the main reasons DPS is so popular among the community is because there is 100% learning and 0% marketing. If you wish to learn more, you can visit our website, dps10.com, or write to contact@dps10.com, and our colleagues will reach out to you. And then we have a direct number, that is, Satya will be putting down all these links and numbers on your chat window, so you can use them. So go ahead and book your seat. One thing you should really remember is that the DPS pass price increases on the 1st of every month. So we are on April 18th, and the next pass price will increase on May 1st. So before that, you've got to book your seat if you're willing to participate. And if you want, a lot of you do not know that the company, most 95% of the delegates, DPS delegates, are sponsored by their companies. So if you wish your company to sponsor you as well, our DPS team can invite your company, and then you can come free of cost. So you can visit dps10.com, and you will see these 2 links: book now and would you like the DPS team to invite your company, and you can use them as you wish. So why should you really care about the conference? One of the major thing is reskilling and upskilling. If you want to stay up to date and reskill and upskill, DPS is the place for you, where you get to meet a lot of experts and delegates and share and learn from them. And of course, it's a networking opportunity, and you make connections for life. World's best infrastructure, you will see best infrastructure at Radisson Blu, in terms of facilities or be it the network issues, anything. And DPS involves the community. What does that mean? DPS, whatever you want to learn at DPS, all the sessions that you see that are delivered at DPS are voted by the community. So all the sessions submitted by the speakers will be put up for vote for the community, that is you, and you can choose what you want to learn at DPS. And of course, there is a highly curated content and disciplined execution. So next step, evaluate DPS by visiting our official website. You can see all our past content up on our website, SSGS for 2015, SSGS 2016, DPS 2017 and 18. So you can see the kind of speakers that we have got and our testimonials, and you can always make up your mind after researching a bit. DPG core team, we have Amit Bansal, who is the founder and president. We have Manohar Punna, who is the vice president, and Avnish Panchal, Vijay Mishra, Vijay Reddy, Anupama Natarajan, who joined our core team recently, who's an MVP from New Zealand. We have Sandeep Pani, we have Prince Rastogi, Surbi Agarwal, Sakharam Shinde, and Devdatta Nath, who help us with events and all the DPG activities from Pan India. So these are the dominant teams that you can see on your screen from Bangalore and Kolkata. And this was last year at DPS 2018 in August. On the screen are DPG core team and the dominant teams with Amit Bansal. Special thanks to Microsoft for supporting us in organizing these events and all our community initiatives. DPG community. If some of you are joining for the first time, you should be aware that we have a lot of free content out there, a lot of free videos that you can choose, labs, magazines, etc. You can all go ahead and use all of that. And we have the new meetup model coming up, which allows you to become a regional mentor with DPG and also organize meetups in your own company. So all you have to do is fill out the regional mentor form, and our team will reach out to you. So if you have any questions beyond this webinar, you can join our Facebook, LinkedIn, and Telegram groups on mobile. You can ask questions or answer questions for the community. Yes, all our webinars are recorded. That is a popular question that we get. All our past webinars have been recorded and uploaded on our YouTube channel. So I will be putting down the links. And we also do a lot of SQL videos where we put up on our SQLMaestros YouTube channel. So do not forget to subscribe for updates there. So without any further delay, let's get started with the webinar and let's welcome Kevin Feasel. Over to you, Kevin.
Hey, thank you. Let me take over sharing, and I'm going to share my entire screen. All right. Hi, everybody. Sorry for my voice. I am getting over a cold, so if I break into an awful coughing fit, that will be the reason why. We are going to talk about applying forensic accounting techniques today. So as mentioned, my name is Kevin Feasel. I'm a data platform MVP out of Durham, North Carolina, and I have a website called Curated SQL. The idea of Curated SQL is that I try to like to find and link to 5 to 10 interesting posts per day, somewhere in the space of database administration or development, Python, R, Spark, Kafka, Hadoop, Power BI reporting services, or anything else in that broad data platform space. That's curatedsql.com. My talk today is going to be focused around a case study. So this happened in my neighboring town of Raleigh, North Carolina, and has to do with an auto parts company who's working in conjunction with a few county employees to defraud the county of over $5 million over a multi-year period. The way that this worked was that this auto parts company would submit invoices under the limit for what required 2 signatures. At the time, if you submitted an invoice under $2,500, you only needed 1 signature. And so the auto parts company worked with a few corrupt county employees to submit phony invoices, get those cashed, and split the money. It turns out that this actually went up to the top of the department, including the director of the transportation department. So in the end, there were several people who ended up in jail over this. The auto parts company ended up paying $3 million to the county, including a $2.5 million criminal fine for doing illegal activities. So I liked this case study a lot and made it the focus of this talk. We're going to go over some of the techniques that forensic accountants were able to use to break this, to figure out that there was wrongdoing, and to eventually put people in jail. That said, I want to emphasize that this talk is not directly about finding fraudulent data. For a database specialist, that could be a DBA or a database developer, hopefully there's no real fraud going on in your environment. You can still learn a lot from these techniques because in a lot of talks, you'll hear people say, you really have to know your data. And I'm just as guilty of that as any other speaker, saying, you should know your data, maybe giving you 1 or 2 ideas of what that means. Well, this talk is all about knowing your data. when people say know your data, we're going to get into some detail on what exactly that means. We're going to use as a case study another fraudulent bus transportation example, but again, this isn't just about fraud. This is all about knowing your data. So let's jump into knowing your data. My example today will be a simplified version of the Wake County fraud case. I want to emphasize this is fake data. I made it all up. This will let us understand those key principles of what happens, of how you can analyze your data without getting lost in hundreds of tables, thousands of tables that a real system would have. So your real systems will be a bit more complicated than this, but I want to give you the gist of how you can analyze your data without having you get lost in, well, what table 29 versus table 28. So my data model is extremely simple. And we start with a line item. So basically, a line item is just an invoice. It's got a date, it has an amount, and it ties to a few things. We have a bus, and a bus is going to need some kind of part or labor or something, which is an expense category. A vendor is going to provide that expense. So maybe we have a vendor who is replacing a mirror on a bus. So the line item will be vendor replaced mirror on bus whatever, and it costs some amount of money, happened on some day. Some county employee is going to approve this invoice. And that's really our entire data model for today. So it's a simple model, but it should do the trick for us. The scenario that I have here is that we are working at a company that provides external audits to government agencies. So a county transportation agency brought us in. The only thing that we know coming in is a data model, and we have a read-only login. So I want to see where we can go given just those two bits of information. And the first thing I'm going to do is some basic analysis. Within basic analysis, I've got a few things listed here. Summary analysis is the initial part. I'm looking at things like row counts, data types, and keys. So when I have a brand new database, I know nothing else about it. I'm going to pop open Management Studio, go to the reports. So right-click on the database, go to Reports, Standard Reports, and then Disk Usage by Top Table. I can sort that, and it'll give me a result that looks a bit like this. So I have a table like line item, which is at the top. I'm looking especially for things with a lot of rows. Those tables that have a lot of rows will typically either be log tables. In that case, I'm not that interested immediately in them. Historical tables, I'm probably not that interested in them. Or big fact style tables, I am interested in those. When I say fact tables, if you're familiar with the Kimball model of warehousing, I don't truly mean fact tables in that way. What I mean is closer to a fact style table, meaning you have a lot of measures, you have a lot of calculations that are stored in the database, and it's the bulk of rows. I contrast this to dimensional style tables, which tend to be a lot smaller and which tend to give explanatory data. So in an OLTP system, you can think of those as tables have lookup values. You can think of them as tables that you don't necessarily have a huge number of rows, but you're going to join to them to learn more about your data. So I take line item, and I'm going to check out its metadata. What kinds of columns it has, what keys it has, look at the top 100 rows. Just get a brief idea of what this table is trying to do. So here we've got a pretty good schema. I've got keys going out to other tables. So then I can go to step 3. Once I have some understanding, like I can see based off of column names, okay, there's a date, there's an amount. There are some other things. So now I can recursively look at tables with foreign key relationships. So I had a bus ID. Well, let me go look at table bus. I had an employee ID. Let me go look at employee. If there are foreign keys that say the bus table has a foreign key to someplace else, well, I'm going to go look at that. What I'm doing is branching out, starting with what I think is an important table in the middle, and I'm learning as much about it as I can and building up sort of a mental model around that slice of the database. So I keep going through these foreign key relationships until I run out of the new tables in those key relationships. So then I go back to the drawing board. Okay, so I saw a line item. I ended up seeing bus, and so I saw bus, expense category, vendor, and employee. Those all have key relationships to line item. The next big table is calendar. So I could check out the calendar table. It turns out calendar is really just a date dimension. So I could then check out vendor expense category. And vendor expense category is a way for me to say that certain companies only sell certain types of parts. So I may have a company that manufactures glass for buses. And that company that manufactures glass for buses isn't going to sell fuel as well. We'll get into the analysis a little bit more, and you'll see a little bit more about these tables. So this is really high level at this point. If I don't have a database diagram, I want to start creating at least one. For a real life system with hundreds, thousands of tables, I'm going to have multiple database diagrams. I'll probably have one per major slice, and that'll help me keep in mind what's going on. This is a fairly slow iterative process for really getting to know the data, but the advantage is that once you're done, you have a pretty good understanding of how things relate together. You don't know all of the business rules around the data, and you don't necessarily know all the weird relationships in the data that aren't explicitly linked as keys, but it's a start. So once I have that start, I could get into the next phase, growth analysis. This is looking at changes in ratios over time. Typically, you're going to do this against an additive measure like revenue or cost. You're looking at things that are fairly high level, and you want to see how things move over time. That time could be yearly, it could be monthly. You may try a few different routes. I like to start with annual because people tend to think in terms of years. So I'll have a year. What's the number of customers this year and the number of customers next year? And you can see the high level trends. Then you can dig into lower level in case there's the need for granularity at more of a monthly or weekly level. But start annually, then move down. So let's get into our first demo. All of my demos today are in Jupyter Notebooks. Most of them are going to be in R. There will be some in SQL. I have here a couple of packages in R. One is called the Tidyverse. The other is ODBC. The Tidyverse is an opinionated set of packages designed around tidy data. Tidy data has a long definition that basically adds up to voice cod normal form and then denormalized to add attributes. ODBC allows me to connect to a database. So I'm going to use my ODBC driver. I'm going to use a package called DBI, which is part of the Tidyverse, to connect to an ODBC connection. To connect through ODBC to my local SQL Server instance on the forensic accounting database. And I'm going to run a few queries using the db-get-query function that simply grab information from each of those explanatory tables, those dimensional style tables. Within R, one of the first things that you can do when you have a data frame is to run str, get the structure of that data frame. That'll tell you, oh, I have 700 observations or 700 rows of 3 variables. That is 3 columns. We have a bus ID when it went into service and when it was retired. These are character dates, so I want to use another package called Lubridate, also part of the Tidyverse, and convert them to date types. That way I'll be able to analyze data by year, by month, or however, a lot more efficiently. So once I've got that, I can use a couple other high-level functions in R, summary and head. Summary will give me a quick roundup for each variable. And for numeric or date variables, we're going to get a 5-number summary. The lowest and highest points, the 50th percentile, which is median, the 25th and 75th percentiles. R gives us as well a bonus, which is the average or mean. What we end up seeing is that there are 468 buses with no retirement date. So we have, at the end of this period, 468 active buses. Turns out there are 700 total buses. And here's what the first few rows look like. So there are some buses that have been in service since the beginning of this data set, which actually is 2011. I purposefully made it 1990-0101 because, oh, well, who knows when those buses were really first in service, to give you a little bit more realistic scenario of imperfect data. Some of those buses that have been around for so long are still running, and then others have already been retired. For employees, there's not much information here. We just have employee names. Maybe we'd have more details somewhere else. For expense categories, this is where I was mentioning that for a bus, there's a lot of different types of parts of the bus. There's a lot of stuff that you have to think about, like fuel, like maintenance, repair. So we have each one of those as a separate category. And we have 15 vendors in our data set. These vendors are going to offer their services over certain categories. So, for example, this vendor offers switches, electrical, signs, seat belts, and so on. They offer a lot. There are other vendors like these 2 fuel sellers who only sell fuel. They don't do anything else. So we're seeing a high-level, quick summary. What I'd like to do is group the data, and you can do that in R pretty easily by using the group by function. So I'm grouping it by vendor, and then I'm summarizing to get the count. So count of records per vendor, which you can think of what the SQL query would look like. It would look very similar. And we noticed fuel suppliers had 1 apiece, whereas other companies like Safety First has 12 categories they sell in. So there's a pretty good spread in how much people sell. And we can group it by expense category and get the count. That's going to tell us how many vendors sell in each category. Ideally, we want to have some competition. We want to have at least 2 or 3 vendors who are in a category. Well, there are some categories where we only have 1 competitor. And we might want to keep an eye on those because when you have multiple competitors, you can compare prices, you can compare levels of service. Maybe you can see some of the benefits of competition. With a single seller, you might still be doing well, but there can be risk. All right, so that was our summary analysis in R. Within growth analysis, I want to check out how many buses do we have per year. To make this easier, all buses are retired on January 1st. New buses are bought on January 1st. So all I have to do is check to see the first day of the year. And I'm using my calendar table, which is really just a date dimension that has a bunch of columns that relate to the day of the year. So like the calendar day of the year, what quarter that's in, what month that's in, what week that's in, and so on. I'm going to use ggplot to lay out a line chart with dots of how many buses we have in service. And you can see it's pretty straight line. It turns out that we add exactly 14 buses each year. Next, I can look at invoices. So my expectation is the number of invoices is probably pretty close to linear with respect to the number of buses. that if I add a new bus, then I'm probably going to get in new invoices per year. If I had 10 buses, I'll get 10 times in new invoices. So the way that I'll calculate that, SQL query against the line item table, get the count of number of invoices by year. And I'll plot that out. We end up with a straight line, almost straight line, there's some noise, and a huge outlier in 2018. That's interesting. Maybe something happened in 2018. We don't have enough information to tell anything for sure yet. But from 2011 to 2017, that followed my trend, my thought pretty well. So I'm curious about 2018. With expenditures per year, instead of getting the count of items, I'm just getting the sum of line item amounts. So I lay that out, and again, pretty straight line until 2018, where there's a difference of about $1 million. That's a huge jump considering that in prior years, we never hit $1 million. So back of our minds, we're going to want to keep that in consideration. But at this point, we've got no hard information, just a big increase that we should investigate. So keep that in the back of your mind. We will come back to it. In the meantime, the next thing that we may look at in basic analysis is gaps or the lack of a value. There are cases like invoice numbers, purchase orders, check numbers, where I want to see the contiguous set of numbers. So if I have check number 1000 and check number 1001 and check number 1003, I'm going to want check 1002. The reason for that is pretty straightforward. If I'm an accountant and I see 1000, 1001, 1003, but I don't see 1002, somebody could have stolen check 1002, written the check to somebody, maybe himself, put a number on there, cash the check, and we may not have record of that check being cashed. So there's a discrepancy in money that might be hidden. It's a way for people to embezzle money. Accountants really don't like that. They want to see continuous sets of numbers. We have a couple of ways in T-SQL to figure out if we're missing any numbers. So let's look at those in the next notebook. So here I'm using, this is a Python notebook that is going to use something called SQL Magic. SQL Magic is just a way for me to write a SQL statement in line within a notebook without having to put it in strings like I did in R. I'm going to connect to an ODBC connection I've already created. It's called Forensic Accounting. That just connects to the local database, the Forensic Accounting database on my SQL Server instance running locally. The first query I'd like to run takes advantage of functionality that was added in SQL Server 2012, and that is the lead window function. What lead is doing here is it's saying we have our current line item ID, and what I want to get is the next line item ordered by ID. So lead gives me the next one. Lag gives me the prior one. And I'm looking for cases where the current line item and the next line item have a gap. And after running this query, what we see is that we're missing 6 and 7, 14, 20, 199, 200, 201, 202, 339, 340, 341. That's about a dozen line items that we're missing. And if I'm an accountant and I'm looking through these, you've paid people money. We don't have records of these payments. That can be a problem. That could be troublesome. We may not be able to tell regulating authorities that we've followed all of the law. We may not be able to tell stockholders that we've taken appropriate care when making purchases if we don't have this data. If you're on an older version of SQL Server, you can still use this second version, which uses a tally table to get the individual records. So I'm building up a tally table. If you're not familiar with this, a tally table is simply a table of numbers, just consecutive numbers that are running through. We're going to join to the line item table. It'll be a left join because I'm looking for cases where that line item ID is missing. And if I run this, we're going to get back the values that we are missing. So again, I can take those and start asking questions. Why do we not have these values? What happened to them? And in our database, I purposefully deleted them, but that's me stepping from behind the curtain. There are a couple of cases where a person may not deliberately have deleted the records. If you are using an identity integer or a sequence, it is possible that you will have gaps in your results. If you try to insert, let's say you have IDs 1 through 6 already in the database, and you try to insert, the identity column is going to be 7, but if we have to roll back that transaction, if it fails, 7 is lost forever. The next insert will not be 7, it will be 8. Even though 7 never was really inserted into the database and was successfully entered, we lose that 7. What that means is, for something where accountants need to know that the order is sequential, that the order is appropriate, we cannot use an identity column. We also really can't use a sequence because of the same reason. If you roll back that transaction, the service that grabbed a sequence ID can't return it to the sequence generator and say, oh, I never really used this. It's gone. The next insert is going to grab the next number. The only way that I know of to really successfully build this would be to have a separate table of your own that holds a key of the current ID. You lock the table, put it in serializable mode. You make your insertion. Only after everything commits successfully do you update the table and mark that you're ready for the next value. Otherwise, with identities, with sequences, you are liable to skip values. So that's not going to be a successful result for an accountant. The next thing I want to talk about is regression. So with regression, we have some variable that we want to explain. And in my case, I want to explain the number of invoices or the total amount of money spent. And we have some variables that we can use to help predict those dependent variables. I may have the number of buses. So I think the number of buses helps explain how many dollars we spend. Thus, my number of buses is the independent variable. As that changes, we expect it to change the amount of money. In real life, this was one of the things that the accountants were able to use to prove that there was fraud. And they laid out a simple linear regression of the number of buses that Wake County schools had in service and the amount of money they were spending on maintenance. And you'll notice that they drew a line. Personally, I think that there's economies of scale so that it's actually more of a sloping curve as opposed to a line. But whichever route you choose, that is a difference of $2 to $3 million. And so they were saying there's a huge amount of money that's just being spent that doesn't make sense. The number of buses increased, but you're spending so much more per bus now. And they were able to dig into it further. So let's try doing this technique on our own. And we're in the next demo, regression analysis. So I'm using the same R packages as before, tidyverse and ODBC. I'm going to connect to the same database, and what I have is a SQL query that gets the number of buses per month, the number of invoices and sum of invoice amounts per month, and then returns that query. So I have 96 data points from January through December 2011 through 2018. I can then use a function built into R, LM, which is a linear model, linear regression model. So my first thing I'd like to do is say, can I predict the total invoice amount given the number of buses? I run this, and here are my results. So let's talk through these just a little bit. The number of buses is my primary variable. It is, according to these 3 stars, significant. What that means is, yes, there's a strong relationship between number of buses and total invoiced amount. Specifically, if we add a new bus, we expect to add $522 per month to our expenses. This model explains about 38% of the total variance in the data. And we can see why that percentage explanation is so low by plotting out our results. By the way, to give you a rough idea, 38% for a social sciences survey is actually a really high number. So an R squared of 0.4 is pretty good for an economics paper, for a sociology paper. For physics, you want an R squared that's closer to like 0.999 or 0.9995. Much lower than that, it's not a good result. For an accounting scenario like this, I'd like it to be in the 70 to 90% range. 40% is too small. There's so much that we have not explained that I'm concerned if that's the best I can do. So let's talk through why the variance is relatively high. And there are 2 reasons. Number 1, our number of buses does not change over the course of the year, and yet our dollar amounts change. So that says that there's something happening each month which is some factor. Maybe during the summer months, we have to do more bus maintenance because during the winter, the kids are going to school, so you can't have as much spent on buses. I don't know. The other part is 2018, there's this gigantic difference. We saw that in the summary plot where the dot was so much higher than everybody else's. So those are 2 factors. What I'd like to control is, well, let's just throw out the 2018 example. Let's just stick with 2011 through 2017. Maybe we can get a better result there. So I can use filter to filter where the year is less than 2018. If I run that, what we get is, again, a significant result, this time $187 per month. And we explain about 41% of the variance. Again, that's still not that great. What's happening is that we have our dollar amounts. Whoops. We have our dollar amounts. There we go. Like $60,000, $70,000, $80,000 per month. And we're off $10,000 to $30,000. So we're off by a pretty good amount each month. So I thought then, okay, maybe I can't get dollars, but perhaps I could get the number of invoices a bit better. So summarizing, filtered earlier than 2018, we explain about 45% of the variance. It's a moderate increase. It's not that great of an increase. But basically, what this is saying is you add a new bus, you add on average 1 invoice per month. So then I thought, all right, I've got a couple more features. One of them is calendar month. The other is calendar year. So maybe we have that seasonality effect, like buses in summer, you have to do more maintenance in summer. So I can add the month and try to regress against that. The R squared doesn't really change. It's 45 to 46%. That's not a real change. The calendar month, you'll notice no stars. It is not considered statistically significant. It does not look like the calendar month actually changes the amount of money that gets spent or the number of invoices for the bus. So that's not a good variable, at least how it's constructed right now. So then I asked, well, what if we used, instead of calendar month, calendar year? And we show our summary. This is a really interesting result. By going to calendar year, our R squared stayed at about 45%, but now it's saying nothing is significant. This is an example of something that is called multicollinearity. Multicollinearity is one of 3 major problems that you may run into with linear regression. What's happening is that the number of buses corresponds very closely to the calendar year. You may remember the line chart we drew of number of buses per year. That correlation is extremely high. The linear regression is struggling to tie together what part of the factor goes to number of buses, what part of the factor goes to calendar year, because all the change is really getting absorbed by both. You can use the core function in R, COR, to get a correlation between 2 features. So here I do it for number of buses versus calendar year, and 97%, 98% correlation is extremely high. If you're over about 40%, 50% correlation, I'm concerned about keeping both variables in a regression. By the way, this also works on the negative side as well. So correlation ranges from +1 to -1. If you have a correlation of 0 or 0.1, -0.1, relatively low numbers, close to 0, I'm fine with that. Keep those variables in. They're separate. They're close to independent. If you're at -0.9 or +0.9, throw them out. Keep one, don't keep the other, or merge the 2 together, or basically don't include both of them in your analysis. Or you'll end up in a scenario like what we saw above, where you don't lose any of the explanatory value in terms of percent of variance explained for the dependent variable, but you lose explanatory value in which independent variables actually matter. After digging through this, I decided, okay, maybe the monthly data we're not doing a great job of predicting, but let's try annual data. So instead of doing it by month, I'm just going to include calendar year. Now we're explaining 97% of the variance. And I can plot, and we can see this is number of invoices. So there are about 4,000 to 5,000 invoices per year, and we are within 100. That's a much, much better result. So we can see, okay, the number of buses tracks to the number of invoices on an annual level really well. So I can analyze at that level without being too concerned. At the monthly level, there's something else going on in there that I can't explain yet. If I talk to the people, maybe they'll give me some hints. Maybe I can dig into that further, but at least I can predict at the annual level. One other thing that we can do is add in 2018. And once we add 2018, we drop from 97% to 71% explained. That's a big drop. And to give you an idea of what we think that the result ought to be, I'm using the pre-2018 regression, filtering for calendar year 2018. And what that says is we predict that this number, 7,700, ought to be more like 5,300, based off of what the historical growth has been. So based on historical growth, we think there should have been about 5,300 invoices. In reality, there were 2,500 more invoices. That's a huge difference. So that's what regression analysis helps us get us. We have more solid proof that there is a major difference. It is a significant difference, and it is something that is worth investigation. So let's investigate by digging into cohorts. We can look at top-level aggregates or a slice to help find these data sets. I can look for cardinality, which is how many unique values do I have in a column. I can also look for duplicates. How often do I see the same values showing up? Or things that should be close to the same, but maybe there's misspellings, there's typos, or something. For text similarity, there are a few techniques that I have up here. You're welcome to investigate them further. Levenstein distance, SoundX, even pattern matching. You can get into natural language processing using something like Word2Vec and building a neural network around that. This can be quite a bit of effort. We're not going to go that deep today. We are instead going to look at more of a numeric cardinality answer. In the Wake County fraud case, there were 24 separate days in which this auto supplier submitted at least 50 invoices, all of which were under that cutoff. So to give you an idea of how important this is, typically, a company is going to submit one invoice per day or one invoice per month or whatever. Submitting two invoices on the same day just increases the risk that one of them gets lost in the mail or that it's lost behind somebody's desk and you don't get paid. 50 is absurd. Nobody submits 50 invoices over the course of a day. All of those invoices also happen to be under a magical cutoff value. This is extremely suspicious behavior. So let's check out some cohorts in our data set. I'm once again going to use tidyverse NoDBC. I'll also use a couple pieces from the data table package, which is another really cool package in R. So we're going to grab duplicates. Here, a duplicate in our world is a day, a bus, and a vendor. So we make vendors give us one invoice per bus per day. And as a result, I don't really expect there to be more than one per bus per day. And I can look, and it turns out that in 95% of our days, or of our possible occurrences, we have one invoice. But there are some cases where we have two invoices or even three invoices. So now I'm curious, who's doing those double invoicing? So that leads me to this query where I say from line item, I get those number of invoices by day. Let's do vendor and number of occurrences where the number of invoices is greater than one. Here's our results. Vendor ID 5 takes the cake. They have 59 separate occurrences with at least two invoices. The next highest is 16, followed by 11, followed by 9. Now, 59 versus 16, that's a 3x size. That's high, but that's not necessarily outlandish. It's something to keep an eye on, but just if you told me this alone, I'd say, you have big customers, you have big companies. Stuff happens in data sets. So let's keep going. We can use the rapply function in R to effectively perform a function over each column in a data frame. And the function we're going to run is getting the number of unique values in that data frame. Line item ID, every row is unique. It's a primary key with an identity column on it. Bus, we have 700 buses. Only 664 are actually in use. And we can see the rest of these. So rapply is useful for figuring out things that look like they're more of reference data versus things that look like they're user entered or have a lot of variance in their setup. So in the Wake County case, their cutoff was $2,500. Our cutoff is $1,000. So I wanted to look, do we have any high value invoices that are over $850, but also less than $1,000? If you're more than $1,000, two people have to sign off on it. But if you're under $1,000, only one person. So I looked, and it turns out there are 996 cases where this happens. So 12 of our 15 vendors do this. And I can use the setDT function to now look by vendor how many times does this occur. And vendor 5 had 525 invoices in this price range. The next highest is vendor 14 with just 88. That's a 5x difference. Vendor 5 has shown up again. So, okay, maybe we want to look a little bit into vendor 5. Maybe they just have some high-value items. They sell some expensive equipment. So let's look at cases where it's over 1,000. Vendor 5 doesn't show up at all. It's a little suspicious. Maybe they have high-value items that just sell between $850 and $999. So I decided to look where the amount is greater than $995. 411 invoices are 1 penny under the limit. That's a little weird. So I'm curious. Okay, let's look at high-value invoices by employee. So I run data table setDT. I key it off of employee ID, and we have 4 employees who have at least 100 invoices, and all the rest have 40 or 50, 30 something to 50. What happens when we look only for vendor 5, the amount's over $995? There are exactly 4 employees. But maybe those are the only 4 employees who deal with invoices for this company. I've seen companies where that happens. I have a set of people who fill out a certain set of invoices. It turns out this is not the case. All 12 of our people have done invoice work for that company in 2018. So again, we're starting to build up some evidence that something weird is going on. When you're comparing different members of a cohort, keep in mind that there are 2 different types of differences. You have differences between groups. So vendor 5 has different behavior from the other vendors. There's also differences within a group. Vendor 5 may have sold a different amount in 2017, 16, 2015. They may have changed significantly in 2018. One of the ways that we can look across groups and within a group is called a box plot. So that takes our 5-number summary and lays it out on a graphic. So here we have the 50th percentile, the median. Here's the 75th and 25th percentiles. We can also see the max and min points because they're going to be the highest and lowest values. Now, this range is called the interquartile range. We're looking at a point that is 1.5 times the interquartile range and then up to the next value. Well, we don't have any values up here, so we kind of move down and say, oh, well, that's the top value. And we draw the whisker above and below. If there are any values that are outside 1.5 times the interquartile range, we draw a dot. That's an outlier. Real data has outliers. So just because you see an outlier does not mean there's a problem. And I'm using outlier in that last case, I was using it in a technical term. Now I'm going to mean it as a more generic, outside the norm, potentially strange. Real data sets will have outliers in both definitions of the term. So just because you see them does not mean something bad has happened. It's just the way life is. I'm also interested in clustering behavior. Here my cluster is $2,500. That was the cutoff point in the Wake County example. In my example, our cutoff point is $1,000. My expectation is, I think there are going to be people who will submit invoices just under $1,000 to get under that limit. And there may be a wall between $1,000 or between $999 or $900 and $1,000. So I can dig into that and see whether or not this is the case. So we're going to use tidyverse and ODBC once again. We're going to connect to our forensic accounting database. And this is a query of line item as well as all of the other explanatory information. So the bus info, vendor info, and so on. As a quick reminder, because we've been doing this now for about 30 minutes, here's what initially interested us. This jump in number of invoices by year. Fairly flat growth over time, and then bam, a major increase. So what I want to do is graph the box plot of the number of invoices by month, grouped by year. So this is 2011 and 2012 up through 2018. And we can see that there's a fairly tight range for each one of these years up to 2018. Also interesting, we know that there are at least a couple of points that look like they would be within that cone of where we would expect our results. I can't tell you much more just based off of the box plot, just that there's at least a couple of months that look like they fit, and then some months that look like they don't. The way that I can show it to you is using a scatter plot showing you the number of invoices per month over time. And here I think you can see it even clearer. You have a normal range, and then we have a cluster of values that are way outside that normal range. If I drill in to filter on calendar year 2018 and lay out a dot plot, I have, again, normal months, I have abnormal months. This one right here, that's September, may or may not be normal. You know, I can argue that only these three are really normal, that the September is a little outside the norm. So it could go either way, is what I'm saying. Let's pivot and look at expense category. So what this is a box plot of how expensive invoices, the sum of invoices per month is for each of these categories. And the one that's interesting to me is glass, windshields, and windows, because it has the highest moving outliers. You know, this one is also pretty interesting because you can see the box plot itself, and then there's a big difference in several high outliers. Those two also have some high outliers. And nobody else really has that many high outliers. So let's look at glass, windshields, and windows. This is just another way of viewing that data. This time I am looking at the mean invoice amount. So again, big outliers. So I look at glass, windshields, and windows, and I ask, who is selling in this category? It turns out the name Glass & Sons Glass & Accessories. If you guessed that this is vendor number 5, you are completely correct. So Glass & Sons is vendor number 5. They have a category that averages just under $1,000, that has a high point, $999.99, has a bunch of outliers. So let's dig into Glass & Sons. What I would like to do is look at all of the stuff they sell in. I looked at vendor expense category, and I know that they sell in these 4 areas. So prior to 2018, let's build a box plot. Here's what it looks like. One thing before I get down into the image, I want to point out, Geom box plot, I added a var width equals true. What that does is it says that the width of the box is equal to the number of data points. So the number of invoices. So what that means is that, for example, Safety First and Glass & Sons sold just about the same number of lights and reflectors. They also, as you can tell from the boxes, sold at about the same price. If I scroll down here, you can see on the axis dollar amount. So they sold for about the same dollar amount. They sold about the same number. Same with mirrors, same with windshield wipers and parts. Very competitive, in other words. They were the only sellers in the windshield, what is that one? Officially, glass, windshield, and windows. Notice that the median prior to 2018 is about $200. Okay, let's look at 2018. So we're going to filter instead of less than, equal to 2018. This behavior looks quite different. Notice that Glass and Sons has the big boxes compared to everybody else. That means they're selling more. Notice that their price is way higher than everybody else. That means they're charging more. This went from an average of, or median of $200 to a median of $999.99. Things are getting weird. This is not what I would expect. This is not normal behavior. So here's where I'm really starting to see there's something suspicious going on here. However, in order for me to make a claim that there is potentially fraud, I need to be able to explain both sides of it. In a fraud case, we would have a bad vendor, but there would also have to be employers or the employees who are filling out these invoices, who are approving the bad invoices. So let's check out our employees. This is a spread of invoices by amount, so box plot of amounts for each of our 12 employees. And I would lay out that there is no significant difference in these 12 employees. They all handle invoices large and small. So let's look at prior to 2018, specifically when dealing with Glass and Sons. This is our normal behavior. So I look at this, normal behavior. Everybody's working on some invoices of different amounts. There's no real differences that are worth getting into. So I look at 2018. That behavior is different. Notice that I have 4 employees whose behavior looks different than the other 8. So, hey, perhaps something natural changed during 2018. So I include the months that are normal. It turns out I did not include month 9, September. I called September weird. Here are the normal months. Okay, there are big differences between these people. But nothing too crazy. Again, in real life, you're going to see differences. The reason I'm tutting that is you look at the crazy months. And in the crazy months, these 4 people, all of them had way more in terms of number of invoices, way more in terms of average price of invoice, and the other 8 people shrink off into insignificance. So during that multi-month period, my expectation is that these 4 people were likely working in conjunction with Glass and Sons to do something. One extra bit of evidence is to look at clustering behavior. I'm building a histogram of the amount. So the amount of each line item, and you can see a drop, but you can see this little wall at 1,000. This is behavior that just under $1,000, you're seeing a lot of people submit invoices. Normally, I would expect an asymptotic drop-off. A little bit of noise at the beginning is okay. You know, you've got ranks where some people will have invoices at even dollars or whatever. So that's not too crazy. What is interesting, here's Glass and Sons. Remember, they had 400 some invoices of just under $1,000. Everybody else has normal behavior. So at this point, I have enough information that I think I can go to the accountants at the company and say, we've got some data that's telling us there's potential fraud, and let the accountants start going through the books and pull together the evidence that may be admissible in court. This is information that's good enough to get them involved, and then they can take it from there. Time series analysis is pretty simple. Like at its simplest, you could look at a count of items per day. We did some of this analysis in cohorts, looking for days with multiple invoices, looking for revenue by day, looking at months even where behavior is different. But all of those tend to work on additive measures. With something that's semi-additive, like a bank balance, you want to look at the state of the measure at fixed points in times. You have a bank balance, 9 p.m. UTC. So when I say semi-additive, what I mean is that I can add up bank balances across all of the customers at the bank. But I cannot add my bank balance yesterday with the balance of today and get a real number. So it is not additive over time, but it is additive over customer. When you're digging into details, look for odd date combinations. Things like an adjustment after the journal closes is weird. It's not normal. You also want to look at behavior different times of the week, weekends versus weekdays, early versus late week. This is, again, not just for fraud, but knowing your data. When do people buy products at your customer website? Well, okay, they buy them all on Tuesday night. Well, that might tell you that Tuesday night's a bad night to do index maintenance because people are buying your products then. Holidays can also lead to different behavior. Something like Singles Day in China drives a huge amount of retail. By contrast, Christmas Day drives very little retail because people have bought all their stuff before Christmas Day. My recommendation here is to store holidays in a date table to avoid having to calculate the rules, especially for a holiday like Easter, which is coming up in the next couple days. Easter happens on a different day each year. It's based off of a lunar calendar instead of a solar calendar. So it's a lot easier just to calculate this once, store in a table that Easter is on April 21st, or April 21st, and that Orthodox Easter is on April 28th, instead of having to calculate that every time you try to run a query. The last bit, just a couple minutes before I wrap up, is numeral analysis. This is kind of fun stuff. One high-level analysis of values is to get a count of round numbers. So this is the number of zeros, not before a decimal point. So you throw away the decimal point, and you count the number of zeros. So here we have 3 zeros. Here we have 2, 1, 0. What you normally expect is that the last digit of a sequence of numbers is typically going to be a uniform distribution where everything's got about the same probability of being a value. And instead of running through the demo, because I know that time is a bit short, I am going to just run all the cells here and show you at the end that our data follows a fairly normal distribution, or uniform distribution, excuse me, with the last digit. However, the first digit of a sequence typically follows a pattern like this. This is called Benford's law. In natural data sets, we tend to see the number 1 be the first digit about 30% of the time. The number 9 is the first digit less than 5% of the time. And so I have a quick demo here using a package called Benford Analysis. And I'm going to first build up a data frame. This is the specific percentages for Benford's law. So the number 9 shows up about 4.6% of the time. Using the population of the state of North Carolina, all of these different towns. So we have, for example, Charlotte, which was 818,000 people. I would take the number 8. Raleigh, 4. Greensboro 2, Durham 2, and so on. I can apply those values, and the blue histogram is the number of times that the number shows up. The line is the ideal number of times that it shows up. And you can see that for North Carolina populations, just any population style data set, you'll see this show up. And you're welcome to read through the details in this notebook. I'll give you a link in just a moment. For our line item data set, I do the analysis, and it's, again, pretty close. I just generated this data, and it follows Benford's law pretty closely. Then I looked at before 2018 and 2018. I know that all of my messing with the data happened in 2018. So pre follows pretty well. Even in 2018, it follows pretty well, although the number 9 is overrepresented. So seeing that number 9 be overrepresented could be another clue that we have a problem. Last digits. Here is last digits for North Carolina populations. Looks pretty uniform. Last digits for our data set, very uniform. Typically, you're going to see the last digit be uniform, unless you're looking at something like a budget, where I would expect 0 to be a very popular number. Otherwise, the last digits typically, if you don't know otherwise, it's just uniform distribution. This is an example from a website that regularly criticized a fellow by the name of Brian Wansink. Wansink was a Cornell professor who was considered an expert on food research. And it turns out that he and his graduate students were making up data. One of the ways that you could see that they were making up data is, if you look at this chart, they were fudging numbers. The last digit ought to be pretty much uniform, but people were filling in what I jokingly call the more random numbers, that 3 or 7 or 8 is a more random number than 0 or 5. And therefore, those, quote, more random, unquote, numbers will show up more frequently when people are making up data. So this has been a quick survey of different techniques that forensic accountants use to understand data. We can take those, we can apply them as data professionals to help learn more about our data sets, even when we're not uncovering fraud. If you'd like to learn more, I have links, I have demos, notebooks, everything that I've walked through today at csmore.info/on/outliers. If you have any questions after this talk, please feel free to reach out to me on Twitter or hit me up via email. And with that, I'm happy to take any questions that might be in the Q&A.
Okay, Kevin, thanks a lot for that session. I can see one question in the Q&A panel, but let's give the audience some more time to post their questions. Meanwhile, I have a few slides. I will just take over for a minute or so.
Sure. Let me stop sharing, and there you go.
All right. Okay, friends, if you have any questions beyond this webinar, you can always write on our Facebook groups, the LinkedIn group, and the Telegram groups, like I mentioned earlier. Satya has already put down the link, so you can go and immediately join them. I was mentioning SQLMaestros earlier. We recently finished the master classes. It was 8-hour online classes by experts from all over the world on machine learning, data science, and SQL Server, SSRS, Power BI, and whatnot. It was a phenomenal success. So you can still show your interest. You can go to SQLMaestros.com and show your interest for the topics that you want to learn in the upcoming master classes. We have the SQL Server Performance Tuning course, which is being turned into a video course now. You can watch it from anywhere and how many times you want. It will be coming out soon, but you can register yourself right away and avail a 50% discount on the original price. We also have the unique hands-on labs. You are all BPG members, so you can access all of them. I mean, some of the demos for free, and then you can choose to buy the rest of them. We have the learning kits, which are again based on Amit Bansal's SQL Server performance tuning course. And then if you have any requirement of SQL Server health check, you can always write to us. Our official website is SQLMaestros.com, and you can write to us at contact@SQLMaestros.com. So the Data Platform Summit 2019's pre-cons have been announced. We have 16 pre-cons that are announced as of now. We have topics on Power BI, Azure, DevOps, machine learning, AI, data science, and SQL Server. All the names that you can see here: Peter Meyer, Shiva Harinath from Microsoft. We have Pete Evans, Denny Cherry, Anupama Natarajan, John Martin, all experts from all over the world. So you can choose precons based on the titles. All the abstract is given on the website. The direct link will be given by Satya. You can look at the demos that will be delivered by the speakers, etc., and then choose to attend precons. And remember, the pass price increases on the 1st of every month. So if you're planning on attending, if you want your company to participate and all of that, you can register before May 1st to avail the best price for the summit. To those of you who are joining us for the first time, we also have in-person events that happen pan-India. Our upcoming event is in Hyderabad this Saturday, 2 more days to go, and the agenda is finalized. We have sessions on machine learning, Azure Databricks, and big data and SQL Server as well. So go ahead and register yourselves. DataPlatformGeeks.com/events is the URL. I'm sure you already know. So go ahead and see you all at the event. So that's it from me. Thanks a lot for your time. You can follow us on Twitter at @SQL Server Geeks. That's our Twitter handle. This webinar is recorded and will be uploaded shortly on our SQL Server Geeks YouTube channel and our Facebook groups and LinkedIn groups. Do not forget to join them. So with that, I'm done. And thanks a lot for joining us today. And Kevin, thanks a lot for 2 wonderful webinars that you've delivered for us and our community this month. So let's just see if you have any more questions. So I can just see that one more question, Kevin.
Okay. Let's let's check this out. So gaps. The question was, can I explain gaps again briefly? Yes, the idea here is that I'll have some set of values that I expect to be contiguous, meaning 1, 2, 3, 4, 5, with nothing missing in there. If I have missing values, there may be a problem. And there are a couple of techniques that I showed in a notebook that you'll be able to take home and try it out on your own so that you can see, are you missing any values in your data set? The reason that becomes important is sometimes for accounting purposes, you're expecting these numbers to be contiguous because it's a way of checking that you've done all of the stuff, that you've recorded all of the work, you've recorded all of the payments, for example, that you've actually paid out everybody appropriately. And using the numbers and counting, like I have 20 rows and my numbers range from 1 to 20, gives me a way of double checking that I actually successfully included everything. If something is missing, there's a risk that maybe a payment went out that you don't have in your books. And if you don't have it in your books, then there's a chance that basically somebody got money without you knowing about it. So great. It looks like that was all of the open questions.
Okay, so if there are any more questions, I think they will post it on the groups or write to us directly, and I will forward them to you if there are any.
Sounds great.
Yeah. All right, Kevin, thanks a lot once again from our team here and from the community as well for these 2 webinars this month. Thank you.
Thank you. Have a great night.
You.